Welcome back to 101trading.com. Thank you guys for watching these videos. Today we're going to take a quick look at Morgan Stanley, symbol M as in Mike, S as in Sierra. I have the stock data stretched out a little bit here. As I've mentioned, I like to pull a lot of time as much as I can just to get a better sense of where the stock is. And given that we're in or around all-time highs in the underlying equity market, it's no surprise that Morgan Stanley is erring on the high side. Before I get rid of the volumetric data down here, I'm going to go ahead and just take a look and see if there's anything interesting. This period here in March, late February, and into April of 2020, this down move was seen across the whole market. If you remember, that's when the coronavirus really took its toll or was acknowledged in the US, and the markets fell roughly 30%. So it doesn't surprise me that there was high volume here, because this is one of the big investment bank stocks that people watch. So that being said, I'm not seeing a lot of good reason to keep the volume down here going. And I do like TradingView. I'm using TradingView for this analysis because, they give you this earnings day, and they also show you the dividends. So this will be worth keeping in mind. There was a dividend on this stock recently in the last few days. Nice to have if you own the stock, create a little extra income. It looked like it was 35 cents for the quarter. So not bad. I guess 35 cents is its standard dividend. So for those of you looking to create passive income, owning a certain number of shares and being able to count on basically $35 for every 100 lot of this stock that you own is good money. I mean, you're talking a dollar, what would that be, $1.40 per year per 100 shares. 100 shares right now cost you, $6,700 basically. So is it a lot? No, but it still adds up, and you still get to own the stock. So I'm going to go ahead and get rid of the volume data because we don't need to see it for this analysis. Let's start off as usual with the moving average. I like starting there just because it gives me a good idea of what's going on with this stock over different time frames. And I'm actually going to I'm going to pull it all the way out to basically the bottom of the market that we saw back in late March of 2020, and just focus on this up move here, because what happened in 2020 is pandemic is going to affect the entire market very similarly. In fact, why don't we do this? I'm going to show you guys how this stock compares to the Dow Jones Industrial Average. So in general, you can see that these movements, and the Dow Jones Industrial Average is made up of 30 major companies, but you look at just what I'm looking for is not the specifics. I want to see if the movement is similar, and it's very similar. You can see up movement from late December of 2018, kind of topping out in April of 18. You saw a little pullback. You see it go higher. You see another pullback. In February of 2020, when we started acknowledging the pandemic here in the US and the markets reacted, you see a similar downward move, including the bottoming out. So this stock actually has what's called a very high beta to the Dow. So again, I want to analyze this stock so that we can trade this stock in particular. So let's start with the moving average, as I was saying. And as you guys have probably seen in previous videos, I like having a short term, a medium, and a longer range one. We're going to make our short term green because this is going to be our money. This is our money signal. I'm going to make this a 2-week long 10 trading day, so that's 2 weeks. Next up, we have our midterm. I'm going to use this as more of a selling indicator, so I'm going to put it in red. And then I actually am going to want this. Oh, do I want this in yellow? Our 60-day. This is a 3-month time frame. I'll keep it in yellow just so we're aware of it. So, and of course, if you look, with this huge move down in 2020, the 60-day took a major hit, and it took a while for stock to get above that. But what's interesting is if you had just used the 60-day and bought stock when stock went above that 60-day, you would have made a nice little chunk of money between, oh, we'll just round that up to $40, and you would have exited sometime around $49, so $9 a share in a stock like this that doesn't move that much. And in fact, when you're talking about $9 on a stock and closing out at 49, that's almost 20%, right? So not bad on this stock at all. You can see back in November we had a crossover between the short term, our 10-day, and our medium term, our 1 month. And since then, we've seen this stock kind of go higher until recently. And I would look to exit when the actual stock bars, when the price drops below. Sometimes people will say wait until you get a cross between the 10 and the 20, and I've used that in the past too. But these moving averages are a lagging indicator, and so it's tough to trust them. So even if you had gotten out when price sort of was dancing around our moving average back at the $60 range, if you had bought in here and exited around $64, there still would have been $11 of gain to capture. So not bad on a stock that this is not a very risky stock unless there's a significant scandal in the financial services sector. And if there is a big scandal in the financial services sector, you're going to see it in every other sector of our economy, because this is where the financing, this is where business investment comes from. So, okay, I like to flip the time frames just a little bit. So maybe look at the 1 hour data. Oh, look at that. Very different. Did you see how when you look at the 1 hour data, that makes this very much a bearish chart. You have the midterm, the 20-day, our red, our sell line is clearly above our green even right now. And I'm sure that's only going to be emphasized when we drop down to, say, a 15-minute, right? 15-minute level and the 5-minute. So it really just depends on what your timing is, what your trade horizon is. For people who are looking to hold the stock a little longer, maybe even long-term for a portfolio, you might look to use monthly data. For people that are trying to get in and out in a matter of minutes, 1 minute data or even more tick data might be your best friend. So, definitely set it to the time horizon that matters most to your trading style. I'm going to go ahead and move on. We're going to get rid of these moving averages. And next up, we're going to add the MACD. And I've always been a fan of the MACD because it's a mix of this moving average data, and it tries to get you a little bit of an indication on where strength is in the market and where it's leaving. So a few days ago, we had a crossover in the MACD. When you get a crossover above the 0 line, you typically are expecting stock to go ahead and come off. This means that stock is overbought, and sure enough, it's come off since then. This too is a lagging indicator, so I like to pair it with something else just to make sure that I'm not, seeing things that are not as fruitful. Like this crossover here that happened back on December 9th is fine. We also got a crossover in the moving averages, the short term, if you remember, before the moving average pulled on higher out of that. So I like to pair up different indicators, and it's not a bad thing to look at this one on different time frames as well, just to get an overall view of what this stock is actually doing and how you want to trade it. So the 15-minute, we actually are seeing that we had a crossover below the zero line, which is an indication to buy. And I don't think that was supported as well with the actual moving average data, but you have to decide, which signal matters most to you, or if both are worth ignoring at the moment. So I'm going to move this back to 1-day data. We're going to look at a little Fibonacci retracement, and I'm going to take this move essentially from last April, the beginning of this up move, all the way. Let me move it back out a little bit. We're going to go from the bottom of the market in March all the way to this current level. I'm going to pull it over just a little bit so we can see clearly. And there we now have, so we are approaching at 65.42. That's going to be our 23.6% Fibonacci retracement, which is just a retracement. We expect some level of retracement of the last move. And you see the 38%, 38.2 is at $58. So this stock could head a bit lower. I do think it's interesting in this $46 range. Not only did that provide support back in the summer, back in July, but it also created some support in late September and again in late October. So if stock does approach that line, just know that there may be some buy orders sitting there that are left from the previous levels that are worth keeping an eye on. As well, this 52.50 level in the stock, maybe around 53, has been resistance. So sometimes we see previous resistance become the new support. Same up here at the 65.50, 65.45 range. So lots of interesting levels to keep track of. Rather than try to forecast them, I like to just know that they exist. And if Morgan Stanley does drop to 65.42 and bounce off of that level, I not only know that it's a Fibonacci level, but I also know that there is some previous resistance back in December around this level, and that resistance very well could become support for us in the future with the stock. So that is it for our analysis of Morgan Stanley. Thank you guys so much for watching these videos. Definitely subscribe to the channel. And if you'd like, we've got a free PDF. If you visit our website, 101trading.com, you can grab that PDF. I'm also going to be adding a video there that gives some ideas on creating your own trading strategy. Anyone that's on our mailing list will get that video, and as well, we'll tie it into the website. So that's it. Thank you so much for watching. Have a great day. Bye-bye.